today? Hold the line, Andre says. Okay. Everyone doing all right? Okay.
Good morning, Coach.
Hey, how are you, Steve?
Move your microphone to the proper position, please.
Thank you,
There
buddy.
You
okay, everyone can hear me now. I was taking a sip.
Loud and clear.
Yeah, I was having a shot of ouzo in my coffee this morning, so I had to lift this up to drink it. But anyway, let's get serious for at least a minute before I become myself again. I believe that we had a very important technical event. Hi, Sandrine. Nice to meet you. Hello, Cheryl. Bejram. Hi, David. Vasco. The whole crew of Trading Warrior brothers and sisters. The key technical event that we had was taking out 2975. I humorously called it the line of death. All right, so we're looking at the weekly right here. Okay, so I look for 2-week reversals or, a continuation based on how the market closed a couple weeks ago on Friday. So if by Friday, the S&Ps are underneath 2988.50. Hi, Ingmar. You're going to have a 2-week reversal in the S&Ps. Here's a little closer look at that area. So I kept saying we're testing it, and finally broke through 2975. So if you are short, what you need to do now is monitor this area. I wouldn't want to see closes, this area right here. Look how it's rejected it twice already, 2975 up here, a little above it. Then it went right to it last night and came off and made a new low. So this is really, if the bulls are going to regain control, we need not just trading over it. I'd say you need a close, a daily close. And then if that happens, there's something else going on. But as long as it doesn't happen, I think that the market's going to be on the defensive. And when you look at this, the daily, the next significant area is even more significant than 2975 because this was the ascending triangle that actually measured 3100, and Greg had some target up around 3092. But you know what? Trading is constant assessing and reassessing, and I've been talking about this 2975 level for a long time. Thought that if we breached it, that would be a pretty good sign that the correction might be underway. If we take the breakout away here, I think that seals it. So, that's going to come in right around 2940 or so. And you know what, Steve? I know you're listening to me. When Nixon was impeached, I did very well selling rallies back then. Okay. Although I was only 9 years old when Nixon was being impeached, it worked out. I had a little account, and during recess I'd go out and we didn't have any devices, so I'd have to go to a payphone and call my broker. But that's what I did during the Nixon impeachment process. It wasn't the market went down for a few years, grinding, not crashes, but grinding from 72 to 74 while this was going on. So I think we have a significant technical event, but as I said, always reassessing.
Yeah, you're not taking into account inflation though, because the 70s were, had high inflation. So, if
we
you
came off Bretton Woods too, right?
Of course. And that's why the dollar lost like 2/3 of its value following that. Makes sense, of course.
Okay. Well, I'm just saying that, there is a parallel with impeachment and markets. Even Clinton, which wasn't as serious as an impeachment, you had a bear move for a while, I believe. But, I remember, let's see if Ben is here. Ben, when I interviewed him the last time, he had the Nixon analog. I know Ben stops in here. Oh, Ben is. Okay, so Ben's commenting, Nixon impeach and Trump getting impeached. Okay, that's what he's saying. So there's another, last time I heard from Ben was when the Saudi oil facilities were hit, because we also had an oil shock, Steve. So, right now it doesn't look like an oil shock because oil's given most of it back. Okay. We'll see. I mean, this was a one-day wonder so far. What a great short it was on that. I certainly did not have the intesticle fortitude to short it up there. Okay. Anyway, so S&Ps, everyone with me on S&Ps? Be careful now, protect your 401k, buy insurance. People say, well, why should I buy insurance? It's just a waste of money. It is until you need it. None of us want to collect on our homeowners insurance, but if anything happens, we're glad we have it. Insurance is something that you hope you never need until you need it. Okay, so that's my view there. Interesting action in the metals too. We got up to some fib levels here in the gold, just a little bit above 61.8. Maybe it could stretch to 1540, but silver even looks weaker to me. We couldn't even get up to 61.8. So I was looking for sales around 1878. Maybe it still happens if things accelerate. But right now, the fact that gold has retraced more than 61.8, and maybe it's going to go for 78.6. I think this is the metals are also a sale here. Okay, so maybe not right here. When I say here, I mean a zone. We all have to use our own stuff to fine tune entries and where we're going to be wrong on the trade. But the metals look vulnerable to me as well. And TLT has had a great move from last week. I mean, that's accomplishing a lot. We're probably, right back to major resistance here. But if we get through 44, I think we're going to see 150. The bears would say this is probably a failing rally, but I've been saying, this 160.5 level on the 10-year yields, I think is very significant. That's where we kind of broke out here, 60.5. And if the case for higher yields is going to continue, I think we have to dig in between 60.5 and 154 to get another wave to the upside in rates. Something that people aren't considering because I don't know, not many have seen it in their trading careers. But just like bonds in general have been in a bull trend and stocks have been in a bull trend, it is possible that they could both enter bear trends at the same time, and there may not be anywhere to hide but cash. So, okay, that's right. They rhyme. They rhyme. Okay. Use less leverage when you trade the markets, especially now. So thank you, Ben. Nice scenario. That's why I keep having you back. So I think that's about all that I want to cover. This is the key event right here. And let's see what it does against 75. Looks like it may want to, do some type of ABC here. But I think this is a very significant level going forward. And with that being said, let's see, I'll do it like Blake does. I'm going to pass it over to my colleagues, Steve and Stelios. And Stel, you have any overnight fundy news on what's happening in the FX market?
Well, we do. Good morning. We do have
Good morning,
a couple
my
of
friend.
quite big things happening.
Indeed, we're finally seeing some movement.
Yeah, let's start with the RBNZ, which met a few hours ago, and they kept rates unchanged. Remember, these guys cut rates last time, and they have been pretty dovish, and they continued to cite risks, global risks, and they said there's going to be scope for more stimulus. So it doesn't look like they're going to be hiking anytime soon. And they said the rates are going to be probably going to be low for longer. And I guess most central banks would say the same thing
My
right
God,
now.
yeah, it's like a, it's like a central bank chant.
Yeah, exactly. Well, they're all in tune because we've seen for a little bit of time now that the global economy is turning, and there's a lot of things that worry me on the global scale. So, and I'm sure they worry everyone, like trade conflicts and the Middle East, and growth deteriorating, especially in Germany and Europe. So it's not a nice situation to be in. And remember, in New Zealand and Australia, they have a big trade. The biggest trading partner is China. They trade a lot of commodities, many commodities. So we know that China is the main consumer of these commodities, and they drive the market. So when China sneezes, they catch a cold. Is that the expression? I can't remember how it is. But
yeah,
anyway.
it used to be America catches a cold, the world gets pneumonia.
Oh, there you go. Okay,
Yeah.
I said it completely wrong, but yeah.
Yeah.
So that's with the RBNZ, and I still have a bearish bias on the Kiwi, although it's gone a long way over the past 6 months or so. So I still think I have a bearish bias, but I think we're going to be eventually getting to some nice reversal levels against the dollar, against the majors. So I just need to keep an eye on that. But obviously the main two things that happened overnight, one is Nancy Pelosi, who is the speaker, is launching a formal impeachment inquiry against Trump. The accusation being that he tried to get others, I think the Ukraine, to help smear Joe Biden. Biden, is that how you say his name?
Yeah, his son, Biden and his son, yeah. Mainly
Yes,
his son had a business over there.
Yes. Now the thing is, we have to look at the details. I didn't know that much. I read quite a bit about it. The thing is, for this to be okay, Nancy Pelosi is launching the inquiry. For it to move on, it has to be decided by 50% majority in the House of Representatives. So this actually could be likely because it has 435 members, and over half are Democrats. So they might, go with that, and if they get 50% or more, then that goes to the Supreme Court, and then it's basically a trial, and they need to get a 2/3 majority in order to reach a verdict, and that seems like a very difficult thing.
I think the trial's in the Senate, which is controlled by the Republicans. Yeah, and it would go to the Supreme Court if there was some kind of appeal or something.
Okay.
So that's why a lot of Democrats didn't want to do it, because they figured, why go through the exercise? He's not going to be convicted in a Republican Senate. I mean, they're all still backing him.
Yes.
Very few Republicans have come out to decry him trying to influence the 2020 election. Okay.
Yeah.
And you know what's interesting? He made this phone call right after Mueller had testified, which gave him even more confidence that he was Teflon. Yeah. Interesting, isn't it? Okay.
Yeah. But I think you're right. Why? I'm sure they're thinking, why go through the motions when they need to have a 2/3 majority in a Republican-controlled Senate, like you said. So it seems like a very tall order. So there's a lot of hype about, they're going to impeach Trump and this and that. But really, to get the result is going to be very, very difficult, in my opinion. I mean, I don't know what's going to happen, but obviously,
it will be.
Because you know how politicians are. And
well, that's why Pelosi didn't want to do it, because it's not going to go anywhere in the Senate.
Yeah.
But they have a constitutional duty for oversight.
Yes.
Okay, so if they did not, the this is probably risky, bad politics for the Democrats.
The word constitution is a very sensitive word here. Don't forget that since the founding fathers made the Constitution, and mostly actually in the 20th century going forward, in essence, politicians have used the Supreme Court. That's why, by the way, there is so much fighting over who are the judges that should be appointed.
Well,
Because
it's
in
a
essence,
lifetime appointment.
because in essence, the Supreme Court has become the bypass tool for what the Constitution was saying, right? So parties know that if they have the majority in the Supreme Court, they can get legislation passed, which would have been deemed under normal circumstances as unconstitutional by having enough judges to do it. Let me remind you, for example, that Obamacare passed the Affordable Care Act with 5-4 in the Supreme Court. And there is no question about it. I'm not judging Obamacare here because this is a big conversation and I'm sure, we're going to have big debates, but there is no question about it. If the Supreme Court balance was different, we might have had a 4-5 rejection instead of a 5-4 approval.
Well, that wouldn't have been good because you never would have known me. Because I'm telling you, Obamacare saved my life. Because here in the U.S., I don't know what it's like in Greece, but if you have certain pre-existing conditions, you're uninsurable, which is what I was before Obamacare. And once I had Obamacare, I went in for some tests and found out what was going on. And without it, I'm sure I would not have been here. Okay. Talking to you and making jokes.
I'm happy we have Obamacare then. I'm very happy.
Yeah, see, so go ahead. Are you, Steve?
If you want to have a brief conversation about it, I can tell you the following. First of all, I'm happy that you're alive no matter what was required to achieve that, right? There's no question about it.
Me too. That's 3 of us.
There's no question about it. But fundamentally speaking, Obamacare had big flaws, and the Republicans made those flaws even bigger. That's the funny part. Okay. Initially, they didn't want to pass Obamacare. One of the problems of Obamacare, one of the huge problems that financially makes no sense, and that's why rates are going up like crazy.
Oh, you know what? You're wrong about the Supreme Court because Roberts is a Republican nominee, and he casts his deciding vote for Obamacare.
No. You don't understand. This is not a debate about if medicine should be socialized. There is a lot wrong with.
All right, Joe's right. Stop talking politics and start talking about the market. This is not
come on. Only in the US.
That's what Joe thinks.
Joe, come on, Joe. Yeah, oversensitive American friends.
Okay. Let me continue then with the. It is boring, Joe. Okay, thank you.
All right. Yeah.
So I'm sure we have a lot of, we might have other opportunities.
Anyway, bottom line,
okay.
I'm alive doing face.
Great.
That is what matters.
Okay,
there you
so
go.
The other thing I wanted to talk about is obviously the UK situation where House of Commons resumed today. I think they all expected to get some more holidays, but good luck with that one. And Jeremy Corbyn actually said that he's not going to call for a no confidence motion. And he said that he wants to help the government seek an extension because we all know the deadline is just over a month away. Now, the little detail is that Corbyn is way behind in polls, or he knows he's going to lose in general elections. So he says he wants to help, but really, if he did have a good lead in the polls, I'm sure he was going to be doing the opposite. So that's what the Labour are doing. Boris Johnson had a joint press conference with Trump yesterday, and he was very relaxed, and he hinted that he could still suspend Parliament. I don't know how the mechanics would work or how it would be, but that's what he said. And the question is, if we do, I've been asking myself this today, if we do have another extension, which, by the way, the Liberal Democrats and Labour are both in favor, and it's only the Conservatives who really don't want it. Boris Johnson has said, we're going to get out, but I would prefer to have a deal. So what happens if we get another extension? There's 2 camps of how to look at this. If you have an extension, last time around, the pound rose briefly, and then it just fell. Because we get more uncertainty, you get, things just don't get rolling, they don't get moving. So that's one way of looking at it. But at some point, if you get extension, when does the temporary extension become a permanent one? Or when does the market think, look, this is not going to end?
I've said that since the beginning, Stelio. As long as they don't find a way to put a date that, you know, is definitive and cannot be changed. I don't know how they will legally do that. Since this is a very, very delicate issue that doesn't have a perfect solution and will never have a perfect solution, they will keep postponing it.
Yeah.
So,
And
you know,
it's a very complex
that is
thing,
why
right?
I'm not a fan of Boris Johnson. Quite the opposite, actually. Like, if I want to be honest, you know, even before he became a prime minister, every time I saw this guy, I was like, what a clown is this guy? But I have to tell you, because, you know, I try to have an opinion that is unbiased to, you know, what I see, or, you know, I try to isolate. So in regards to the matter of Brexit, I think that the only thing that can work, unfortunately, with the way things are, is an approach like this. I mean, you need to shut down Parliament, fine, shut down Parliament or whatever. But if you don't find a way to make a date, let's say the 31st of October, definitive, they will postpone it. But you know something? They will postpone it, let's say, for 3 months. Then things will start moving slowly again. Then they will try to make them move faster the closer the next date comes. And when they start stumbling on, you know, walls, they will try to procrastinate and, you know, postpone it once again. But, you know, as we said, this is death by 1,000 cuts. I mean, one way or another, they have to get done with it.
I agree. And it's the best thing for all of us, I think. I've had enough. Yeah, so that's the situation. I'm sure we're going to get more developments, but that's how it stands right now. And data-wise, we had nothing this morning, nothing of note. And we don't have much either coming up, just new home sales of the US. So really quite quiet today.
Yeah. I mean, you know, I'm not even sure. I mean, last week we had supposedly, you know, huge event data coming out and huge events in central banks, and we ended up with nothing. So who knows?
Yeah.
Perhaps now that we have no events, perhaps now we get something. Who knows? It's counterintuitive, but you know, sometimes that's how it works.
Well,
Anything
I'll tell you what we are going to get. We're going to get Andre in the last 15-20 minutes. So he's gonna.
Yeah, I know. And it's a good thing we're getting him today, because you know some things have started moving, which is good. Let's hope there is some follow through to it, because the previous days were just, you know, boring, extremely boring actually. Okay, perfect. Coach, are you still with us?
Maybe not. He's gonna
maybe not. Okay, so let me go through your question. I have some things to talk about, but let's see, perhaps your questions already cover some of them. Chat, let's open the chat. Dale, what is your definition of the market? Okay, let's ask him when he's back. I don't know to which point you were referring. I see it's at the very beginning. Is the stock market, the bond market, and the precious metal market, or the Dale market? Okay. Okay, let's see. Hi. Good morning to everybody. Could you have a look at the Aussie Kiwi? Absolutely. Actually, Aussie Kiwi, quite a nice. Aussie Kiwi is one of the pairs that did produce a few days ago quite a nice rejection. You can see it here. So the Aussie Kiwi, we had spoken about it perhaps a couple of weeks ago, because it took some time for this to manifest. As you see, confluence of resistances up there at 1,083, ascending channels resistance, equality target as well. 61.8% fib at 108, horizontal support resistance area and previous neckline of a head and shoulders formation. You name it, this ascending channel resistance, everything was passing from there. So Aussie Kiwi did find resistance there, and it is attempting to break lower from here. So, you know, a move below 107, in my opinion, opens up a lot more downside. So I'm looking for that support zone, and that might take us back to this larger ascending channel you see here in purple. So, you know, I'm monitoring closely, because of course it's going to tell us if your preference should be Aussie or Kiwi, of course, it depends on, if you're looking to be long or short any of those two against whatever. So Aussie Kiwi currently at key support, and a move lower from that, as I said, opens up a lot more downside and makes that rejection a lot more significant. Now, Aussie and Kiwi, since we came to Aussie and Kiwi, quite nice reversals. I mean, yesterday we had a nice rebound. So we see here a nice rejection from 68 cents having to do with the Aussie. In essence, we've already erased yesterday's up candle, completely erased it. And we're once again at the lows. Keep in mind that, I've kept saying, don't be too optimistic about, any type of rebound here, because in order for me to really get, somewhat convinced that we might be getting like a bigger recovery is, for example, in Kiwi, if we get past 64.25. So, and I think that's what we wrote yesterday as well. So 64.25, of course, we didn't even come close to it. We just had 2 consecutive up days. And today we had some initial gains at the RBNZ, which we've completely erased now and almost completely retraced yesterday's up day. So, it is what it is. Kiwi and Aussie remaining under pressure. And if you have a look at the Aussie against the yen, testing previous resistance as support, quite a critical area here. I mean, if you're bullish, I understand why you would want to be long against this area, but keep in mind that we've been in a prolonged downtrend, and that's a path of least resistance until proven otherwise. Same thing with the Kiwi. We've seen divergences, I mean, on the RSI and everything else, but so far nothing to write home about. In essence, the rebound we got from that ascending wedge did manage to fulfill this, descending wedge managed to fulfill the target, which was a full retracement of that wedge, but then it got rejected from key support resistance area. So, we never even managed to pass the first area of interest. So until proven otherwise, or until we trade above 69.13 in this pair, also the path of least resistance remains lower. And especially if we break this ascending trend line support on the RSI, I think we're headed to new lows.
Steve, I have a question that's
Absolutely.
pretty relevant with what's going on. I know we talked about some higher numbers for counts in US dollar won, and I thought we might put in on the daily a right shoulder, but now it looks like it's could be a third drive, and I think he had numbers like 727 or so as a
Let's have a look at it.
potential
Here it is.
extension. And new highs in the won is not going to help the bull's case in S&Ps.
I agree. Absolutely not. So yeah, I see what you mean. I mean, it can still become a head and shoulders formation, right? But we have to always respect the possibility of more upside, since we've been in a move that started in March,
right?
And it's definitely some type of an uptrend. So
and it could also just be a 2-driver, incomplete with another one to come.
Yeah, but you're right. It can prove to be.
Okay, so you have
like this.
723. Okay.
723. Yeah, is the 161.8% extension. Of course, we can. If you look at this, we can now have a different extension to measure. So there you go. So as you see, there is a confluence here. Let me show you. So if we fib extend this move lower, you'll see the 127 is there. And if we fib extend this move lower, there you go. This, you'll see that we only need the 161.8. There you go. We can delete the rest. There you go.
Yeah.
As you
You
see,
know,
there is a confluence of the 161.8.
yeah, that's what
The
the number I was
1.2.
looking for. Yeah.
Yeah, 723, 724. That's the
Okay.
area that we
Okay.
see these confluences. So yeah,
Got
we
it.
can end up seeing a move like that. And as you said, depends on how we move up there. If we do, we might even have a 3 drive on the RSI in that case.
You know, if you really want to get bullish, Steve, you have the daily up there. Let me just get rid of some of this other stuff. So let's just say that the breakout. Oh yeah, there you go. Oh, okay. Just say maybe that the pullback into March, April is a right shoulder, and you had the neckline at 697, whatever. And then it came back after it broke out 2 days later and tested it. And if you do the width of that whole formation from 615, you get 770. I'm just saying. Do you see what I'm talking about?
Not
Yeah,
yeah,
the
but
whole page and the breakout and the
yeah,
breakout
but
was
something, we have a more relevant formation here because it's more recent. If you want to be
I'm just being
measuring other
macro.
targets, you can see this one, which is more recent. What is this?
What? Oh, the cup handle.
Exactly.
All right. So instead of having shoulders, a lot of cup and handles look like right shoulders to me.
That's a cup and handle. So
Okay.
where would the implied target of this cup and handle be?
That's why I'm asking you.
Let's see. Let's make it green so it stands out from the rest, and let's measure it. It measures to the 161.8% extension of that last move lower at 729. So we have
Okay.
another confluence of resistances.
Yeah.
There you go. Let me move it to the
23 and 29.
23 and 29. Yeah, those
Okay.
are both confluence of resistances. Yes, correct.
Okay.
Correct.
Well, I think that might be 2,800 S&Ps. We'll see. Okay.
Might be, yeah, but let's take it one step at a time.
Let's take it one candle at a time.
Let's take it one candle at a time.
Steve, be nimble. Steve, be quick. Steve, jump over the candlestick.
So you spoke
Ouch.
about.
Oh, you didn't jump high enough.
You spoke about yesterday's price action. So yesterday's price action was interesting. If we take the S&P, which is the benchmark for risk, I hate Magic Mouse. So if we take the S&P, we did break the recent consolidation, but you must remember me mention multiple times the importance of 2960. So, we got 2 more instances that the market proved the importance of 2960 because within that area, we found support both yesterday and a few hours ago today. So, it's an area, of course, as always. It's not like a single level. It extends like from 2952 to 2960. So midpoint, let's say it's 2956, the midpoint of this area, not really that important. But what is important is that if you want to continue lower, if you want to see continuation lower, the market has to cleanly break through this area. Now, if this happens, I do think that we're going to see an extension higher. 2940 is going to be the next area to the downside, but I doubt it that that's going to be that important to stop price. I think that we can easily go back to 2890. Even if you want to look at this as a range, so this is a range. Let's do exactly what we did for the cup and handle formation before. So this is a range that there we go. So look at this. It measures perfectly to 2890, right?
And that was a previous 61.8 level. I notice sometimes after markets are past fibs, I don't know if you do, Steve, that they come into play later when they come back down to them or go back up to them. Have you ever noticed that? There's still memory. There's still memory even if it didn't stop there.
Absolutely. There is still memory because there are still orders, positions, and actual memory of traders. I mean, as for example, I remember the recent important areas in several tickers. The same thing happens with other traders. So, for example, if you have a vested interest, if you have some position in the market, and you see that level getting hit, and you're on the right side of the market, you might decide to take some profit. So that on its own, creates an event if a lot of people do it at the same time. Or oppositely speaking, if you have a position but it's going against you, and you see a specific area that you remember that was important, and the market just slices through it like it wasn't there, then you start getting really worried. And perhaps that's when you decide to take losses. So that also moves the market in that direction. And
yeah, I just want to mention for you, in case you don't know, Mark Newton's going to be with us today. What a great day to have
that is perfect.
A real good, I mean, very good technician and tactician. Absolutely. To be here to see,
and the person that actually understands
what's happening,
fundamentals as well. Yeah, exactly.
Yeah.
So all around it.
Yeah, it's going to be a great interview. In fact, you know what, Steve? I wrote something on my desk. Dale, shut up and listen to Mark.
Yeah, Mark is great.
Yeah, don't interrupt. I'm sorry I interrupt everyone, guys. Thanks for putting up with me during the interviews.
It spices it up. I mean, I always like a lively.
Well, you're a co-interrupter.
Might be unbiased. I agree with you. Unbiased. Yep.
All right, buddy.
I'm with you there.
Take it away.
So yeah.
Good coverage. Yeah. So I mean, the WAN and the S&Ps
break below this area.
Yeah.
I really see a very, very high chance of making it back down to 28.90. So it's all about 29.55, 29.60, 29.52, this general area. So if you like it and you want to be long the S&P, I mean, there is a great risk-reward ratio for you to do so right here, right now. But we slice through it, you might want to reconsider, because, you might find out what we were telling people yesterday at some point. Actually, Greg mentioned it, that, especially bull markets, they tend to move slowly higher most of the time. And, whenever you get a pullback, it might be very, very sharp. And you don't want to be in the wrong side of the market when that happens. So no need to go through the rest of the indices, the US indices, because in my opinion, everybody focuses mostly on the S&P. It is the benchmark barometer for risk globally. So I do think that, what happens in the S&P, the rest will follow. As always, and I'm not going to show it, I've said that many times, the Russell keeps underperforming the rest of the indices. And that is quite a telling thing. Now, having to do with the DAX, because we also, have the DAX to cover. I mean, it's the main European index. We've finally seen some type of a pullback here. If you remember when we covered it on the daily, I said that, listen, we might see some horizontal consolidation, but on the other hand, we might, and then one more leg higher, let's say towards 12,600, and then see a deeper pullback. But if we do drop below 12,300, we do trigger a double top formation, which should take us lower towards 12,060. And that's what we got with yesterday's candlestick. I mean, we bridged through the previous lows. We have triggered double top formation. So 12,060 is the next area of interest. And as you see, the FTSE also double top formation there, triggered once we broke through 7,290. Currently testing once again the 200 daily moving average. Let's see what happens from there, but I wouldn't find it unlikely to see more downside to begin with. Now, let me go through your questions. Seems unstoppable. Hunter Biden. 2969, don't understand. First, it was supposed to be Russia, now Ukraine. Does anything come well for the Democrats? Yeah, I mean, I think that the Democrats are trying to overplay their hands with impeaching Trump, and even if they have reasons to do so, they make the whole process seem less important, and I think that people will start paying less attention to it. Now, that's not a comment about if they should impeach Trump or not. I have no idea what the facts are, but I doubt it's going to happen. And the more they mention it, and the more they try to push through, I think it loses them credibility. I think they should try to do something like that only if they had like irrefutable evidence. I doubt it that we're going to get anything out of it. Is it possible to go through how to interpret the patterns in play with regards to risk, to reward, and taking trades? The patterns in play have an embedded. I mean, when you see a pattern in play in the system, and then I'm going to go to the rest of the analysis. So when you see a pattern in play in the system, it has everything embedded. So you see the reason why, for example, Blake in this case went long, because you see it's a bullish pattern in play, the USD MXN, right? You see the entry area that it makes sense to be long, in his opinion. You see the target, and you see the invalidation point. Okay, I mean, there's nobody here that would put in place a pattern in play that wouldn't have at least a 1-to-1 risk-reward ratio. And this is why he did it, confluence of supports. And always, when somebody opens a pattern in play, they explain why they did that also in the analysis below. Okay. Of course, you're
What
not
a
going to
great
find.
question.
Yeah, of course,
It's
you're
like
not going to find.
I planted that guy out. I planted him out there.
So you're not going to find, the detailed reason of why, because as you see, this pattern in play was initiated at the 12th of the month.
Look at that
And,
website. What a great
we
website.
delete analysis like every week, because then it would become like huge. So we leave like 1 week of analysis up, so you can
Look at all that great content. Oh my gosh.
check back. But it is quite clear. Confluence of supports. If you remember, as I said, that
Yeah,
date definitely.
And if you didn't believe Blake, you could go see what Grega thinks is the same thing, or Andre, or Steve.
Yeah, actually, yes. And for example, yeah, there you go. You can go to Grega.
There's
You
Grega.
can see what Grega thinks. You can go to Andre.
Oh, you guys can have all of this at your fingertips.
Yeah, you see.
For what? For what? 10 pips a month, Steve?
Don't forget to take advantage of the offer.
10 pips.
You have only a few days left.
You risk 10 times that every day, 90% of you guys out there.
You have only a few days left to take
Get the
advantage
edge.
of the offer.
Get the edge. Hang out with Volva.
You get 1 month for free.
Look at that deal.
25% discount, and annual on a 35% discount.
What's a decennial again?
What is what, Coach?
The decennial offer. 10 years.
Oh, okay.
Yeah,
we don't
like
have one. Sorry.
40.
We'll plan one in the next time. So let's see. Questions. Can you have a look at pound? Yes, we will have a look at pound because it's one of the movers. CAD yen, Swiss yen, USD Swiss. Yep, let's have a look at all of them. So USD Swiss to begin with. USD Swiss, there you go. As you see today, it found support. We've been monitoring this ascending channel for quite some time. There is also horizontal support area here at 98.50. And actually, that's what we wrote yesterday in the basic technical analysis, that the USD Swiss was testing the triple confluence of supports, because I don't know if you can see, there's a little green line here as well. That is actually the 50 daily moving average. So ascending channel support, horizontal support resistance area, 50 DMA, quite a nice confluence of support. So far, the pair is responding to that. A break lower clearly opens up the downside. But unless that happens, you need to respect the fact that we're still within this ascending channel. Okay, so USD Swiss on confluence of supports. So, worth monitoring what it's going to do from here. Now, the other question was about, the pound. Let's go to the pound. pound, there you go, pound back testing 123.70, and guess what? This is a key support area. It was a key resistance area until we finally managed to break above it. Let's actually go to the 4-hour chart so you can see it closer. There you go. There you go. So let's see what happens from here. 123.70, it's all about it. Rebound from here, fine. We can see an extension higher towards 127, 126.70, whatever it is. But breaking lower is really bad news, because in essence, it turns the cable back to bearish mode. I mean, short-term bullish outlook was quite nice and had a very nice risk-reward ratio in your favor as long as we're holding this zone. If we break through this zone, all bets are off, and in essence, since we know that we've been in a prolonged downtrend, then you have again to consider the possibility that we're headed even to new lows. I mean, why not? Okay, so 123.70, I'm looking forward to seeing how we're going to close the day, because I care mostly to see how the daily close is going to be. If it's going to be below it, that's really, really bad news for any long positions that have to do with the pound. Now, we also had questions about, let me see, CAD yen, Swiss yen, oh my God. Swiss yen is such a horrible pair to look at, because we're talking about the two safe haven currencies, one against the other. I mean, last time I had a look at it, who knows how far back we were, probably somewhere there from what I see, because we were drawing that this could have been a head and shoulders formation. So if we broke below that neckline, we never did, it would be a nice, bearish continuation. Never happened, but then we had this formation, we broke lower. But as you see, very choppy price action. So, what can I tell you?
Mark Newton in the house.
Okay, then I'll cover the rest. Okay, let's have a look at CAD yen then. Yeah, to wrap it up.
See how excited we are to have you today, Mark?
Indeed. CAD yen. As I wrote the day before yesterday, we actually, because yesterday nothing has changed. Two ways of looking at CAD yen. You look at it on the daily, and you see this descending trend line of resistance that keeps capping any attempt to rebound. So, from the daily perspective, you have every reason to look lower. On the other hand, if you go down to the 4-hour chart, there is this formation that is worth noticing and gives you, if you want to be bullish, gives you a very nice risk reward to do so, because we've had this move lower in quite a corrective manner. I mean, you see it's overlapping, it's slow, it's choppy, and we've stalled at a 38.2. So, you want to be bullish, you can do that if we break above this channel, in which case I would expect, an extension towards 82.20. From the daily's perspective, it's quite dangerous doing something like that without having a very short-term horizon in mind. So that's what I think. We will go over the rest tomorrow. I don't want to eat time from the interview coach. So why don't you pass it to Mark and see what he has to do, what he has to say, what he has to share with us.
Okay, you sound tired, bro.
I am.
You're tired? Yeah. Okay, we'll go take a nap. Yeah.
It's been,
I know.
Long 2-3 weeks, yeah.
Yeah, go take a nap.
No.
All right.
Can't do, unfortunately.
All right. Okay. When you're a senior citizen like me, you have a better excuse. All right, Mark, great to have you here. I'm promoting you to panelist, and I'm going to make sure you're unmuted. And I know this is new to you. This is Zoom. I hear you, Mark.
Hi there, Dale.
How are you, buddy? So
I'm fine.
Great to have you with all the action happening here. To share your screen, buddy, you just hover your mouse over the menu. You'll see a green box that says share.
Let's see, 1 second.
Okay. Like over the menu, it's probably in
Let's see, there's view options.
No, it's you'll see like a Q&A box. You have the whole menu. It's like a drop-down menu, and it'll be a green box that says share, and you just click that. See it? If you just move your mouse around, you'll see participant. There we go. Okay, we're good.
All good. Yeah, how are you? How's everybody? Thank you for joining today. Can you hear me okay?
Yeah, I can hear you. If you want to use your webcam, that's fine too. Oh, that's me. So, all right, Mark. Was yesterday a critical day in the S&Ps? Taking out 2975. I'm curious where your head's at now.
You know, I think near term it was an important and a bearish development. You know, we'd held in this area of range-bound consolidation for the market for the last 9 trading days, which was interesting because a lot of the sectors and really bond yields had peaked out right around mid-month, around the 13th. And so, you know, it was a question to me and to many that, you know, whether the market could absorb all this sector rotation out of, you know, sectors like transportation or what was happening with technology, discretionary, industrials, financials. All of these have started to head actually lower right around mid-month, but yet markets had held up. And so I think yesterday's break was really the first sign that the indices themselves were likely going to have at least a minor pullback. So, you know, near term,
well, you know the difference. You never know. You never know until you look back, do you?
Yeah, well, there are a couple things in that it's proper to start, I guess, from a longer term perspective, but just to look at what's happening with the short term pattern, this is really going to, at least for me, give me a lot of indication as to whether this could be a lot more serious. It's just when you look at the prior area of the breakout, right near this 2940, 2950, I mean, structurally, that's a really big deal. You know,
Yeah,
we consolidated,
so
obviously, the area right near August highs, and we hit that in the latter part of August. So
it measured 3100, didn't get there. That formation.
Yeah, I'm not thinking that that's necessarily off the table. I think that is a possibility, but obviously the next 3 to 5 days I think are going to be lower. So tactically, I think it's right to be a little bearish, and I'm expecting potentially that we try to hold there into end of month, and that actually we could actually start to rally into October, and we'll see if we get to my target's right near 3050 to 3075.
Like the top of the megaphone.
Yeah, there's a lot of things that can be projected up there based on Gann, based on Fibonacci, and so that's just an area that stands out to me. And you know, we rallied up to prior July highs and stalled out there with regards not only to the S&P but many different sectors, and I think that that level has really got to be broken. But you know, when you talk broader markets, I mean, you know, sentiment is still pretty skeptical across the board. We've seen a little bit of improvement, so it's more neutral now, I guess, than it was a month ago. Last month we had real fear, and now it's improved, and so that's certainly, you know, I guess to some extent constructive. I think a lot of the things that people were worried about have been alleviated, but now, of course, with the possible impeachment process and the indecision there, we went from one thing to the other. There continues to be things that worry this market, whether it be...
Does U.S. dollar yuan bother you? That it may not have peaked out here? I mean, I watched the yuan as a trade war barometer.
Well, I think the longer term pattern in that it was actually very bullish. I mean, obviously there's a certain amount of... there's only a certain amount that it can float freely, right? But to get up above 7 from a dollar perspective versus yuan is certainly that's a very good pattern, and so that suggests to me like we could see further yuan deterioration, see further movement, and and the dollar higher. So
you have impeachment, trade wars. I was reading things that someone who supports Trump, he's an economist, my buddy Jim Walsh put it out, that tariffs before they're done could go to 100%.
Yeah, it's anybody's guess. It's tough when you don't really know. I think that we'll look back and see that that was really probably the catalyst that caused the recession. Potentially a couple of years from now, we'll look back and say, you know, that, and only because I think people have gotten very cautious, and you're seeing some pretty massive pullbacks and with regards to just how companies and individuals make decisions in this environment. And I think that's going to be a larger thing. I think that globally, there's a lot of evidence of slowing. You can't really see that yet in the US. So if anything, you know, the Fed was faced with a really interesting dilemma, only because our own, you know, our own economy in the US had actually been showing fairly good evidence of strengthening really since June. The data had been very, very strong. And so I look at like the City Economic Index, and you see just patterns of that. Let me see if I can pull that up real quick. And so, you know, that was actually a very, I mean, this is a very, very big move off the lows. This for those that are
business or consumer, Mark?
I'm sorry.
This index reflects business or the
just economic, how economic data performs versus expectations, just for the year.
Okay.
So this actually shows that as of the latter part of 2017, that most of last year was negative. Data was getting worse, and then actually started to improve pretty dramatically. And so heading into the Fed meeting, a lot of data was beating expectations, and the market was sort of running on all cylinders. That's why, in my opinion, there was a lot of dissension as to what the Fed should do. People say, well, wages are growing, inflation's growing, unemployment's low. You know, why are we cutting if the Fed truly is going to stick to their original mandates, unless they're really paying too much attention to, you know, the global economy and making a proactive cut, or whether they're doing it because of Trump, or, you know, you want to maintain independence. And so, you know,
do you think that Rod,
but go ahead.
Do you think that Rod Serling could have written a financial episode that we're living through now, bro?
Yeah, it's really a very surreal time in a lot of respects. There's a lot of still a lot of frustration and anger, and politically, and now we're entering the election time, and that's going to be really interesting in how that shapes up. And so, you know, my bottom line thinking is that equities likely are going to be positive into next spring, and then we probably for the first time can have a larger peak to this entire bull market. I think we've seen a flattening out, but I don't think we've seen, you know, a lot of people say we're in a bear market, and you could say that potentially about Europe. You look at like the stocks 50 that have been trading sideways for.
We're the last to cave.
But for the S&P, you know, the highest momentum readings we saw in the last decade were really last January, and so yes, the market's been flat. That's really the best way you can put it. We've obviously had a healthy rally off last December's lows, but you know, you look at charts of like the stocks 50.
So is it accumulation or distribution, this flatness?
You know what? I mean, a lot of the cycles that I look at suggest that 2020 into 2022 should be negative, and that you know, I think that what we've seen in the S&P was really the first shot across the bow starting last January with regards to momentum hitting very, very. Let me see if I can pull a couple indicators up here to show you what I'm talking about. So, you know, what's interesting is that you have things like MACD, RSI, those hit very high levels, and we've seen a lot of divergence on a monthly basis since last January. And to me, that's a little bit of a concern. Markets have pushed higher. You can see that the highest point in momentum on monthly basis was last January. We hit an RSI, 14-period RSI hit nearly a 90. We haven't seen that in a long time. We sold off. Markets have pushed higher. This has been lower and lower and lower. RSI is this first momentum, and then the second one, of course, is MACD, which has tried to turn positive, but yet we're well below, you know,
glaring non-confirmations.
So that doesn't mean that it's bearish. It just means that we're flattening out. But I tend to think that you know, a lot of this negativity is going to come to roost probably next spring, and if anything, that would be the first time that we could see at least some evidence of us peaking out. But the markets are still very strong. We haven't seen hardly any.
Yeah.
For sentiment to be neutral to negative, and we're right near all-time highs. I mean,
Great point.
That's
Yeah.
crazy. I mean, really, the markets have been. So I'm looking at really two things. I'm looking at financials.
Dale.
And I'm looking at
Yes.
technology. The one thing I would mention to you. Go ahead.
We just sorry to interrupt. We have a question which is relevant from a friend, Ben. What is your viewpoint for the VIX as well? Because you mentioned divergences, but we also see glaring divergences in the VIX, right?
Good point. New highs in the market, higher lows in VIX.
Yeah, that's a very long-term thing. The VIX is, I mean, that obviously. So yeah, here's the VIX. We seem to be coiling. I mean, volatility is understandably.
It's really
low.
my EKG, Mark.
It's understandably low because we haven't seen any volatility. I mean, it's been. It's tough to look at it and it's low, and you say, well, it should be higher because of all these measures, and people are, that's. It sounds correct, but the bottom line is until you see the equity weakness, the VIX should be low, and there shouldn't be any real.
Yeah, of course, but I mean, we do have higher lows. VIX is suppressed, there's no question about it, but look at the glaring divergence since the period that we were trading at single digits or almost daily to what has happened since, right?
Yeah, so from a technician, do I really want to buy this here? Maybe short term, I can see the movement in the last week could lead us a little bit higher, and I am long a little implied volatility here that I plan to exit in the short run. But my thinking is if you see the VIX up near 21, and then likely we could very easily compress and pull back over the next month. I'm not certain that. We'll see if October turns out to be down or not. I mean, a lot of it's going to depend on, do the indices show any material break? And if they do, then it's proper to respect that. I think obviously S&P getting under 2940 takes us down quickly to 2875 area. And
yeah, I think under 2940 seals it for it to take out the
cannot
early June low.
So yeah, the swing low from August 2822 that can't be broken without causing a very material break. And so, until that happens, I'm going to be very tactical, short-term oriented, and yes, near-term I am negative. I think that pullbacks over the next few days, it's more of a wait and see. I'm looking at a couple things. One is technology, and tech really has to, for the bulls, it needs to really hold. When you look at indices like XLK, that's not necessarily a great stalling out. And so if you start to really weaken, tech is 22% of the market. That could be a lot bigger deal. But, advanced decline is at all-time highs. I mean, you pull back over 2 weeks, but I mean,
there are a lot of conflicting signals.
In history when the market has had a serious pullback and gone into a bear market when advanced decline was at new highs. One was, I think, it was May of 1946. The other was 1956. In March, we peaked out. I think advanced decline had only made a 1-month divergence. And then the last time was 76, where there was zero divergence. Then we began a bear market to 78. But generally, you see a very good lag. This is a leading indicator of breadth. Breadth tends to turn down pretty sharply ahead of lengthy bear markets. And we just haven't seen that. And so I see us as the indices are in very good intermediate shape, even though we have seen a waning in momentum, and that's important. However, you haven't seen any material damage, and sentiment is pretty negative. And, this is a year ending in 9. It tends to be a very good year. And yes, there are some cyclical factors. And for those that study astro, there's some things that coming into play next year that are, historically have been very, very, they've caused a lot of energy, to say the least, right? And so we're ending a period now where I think we're exiting a lot of the positive factors and heading into a more negative time.
But you could go broke in the meantime, playing that out.
Do I really want to be out of the market 100%? Well, maybe if I have a 3-year time horizon, sure. But we haven't seen that technical weakness. So it's tough for me to be intermediate term bearish when advanced declines at new highs, sentiment's negative, seasonality arguably we do have a period of bearish seasonality coming up in October. In pre-election years, it tends to be very negative. The latter part of September is almost a 65% downtime between the 16th and the end of the month. So heading into the end of Q3 is understandably negative. October is also not great for pre-election years. After that, I mean, I could argue that markets probably can attempt to rally into the spring, and that's when I think you see the real divergence. I think advanced decline starts to turn down. Markets attempt to push up, but maybe tech doesn't lead. Maybe you see a switch into healthcare, and that would be sort of interesting to me to see. That's the first time that other things start to pick up the slack, but yet we don't really see any real push. That breadth really falls out of favor.
Where are you at on yields, Mark, and the dollar?
The dollar is making a pretty big move today. I'll start with that, only because you're
Okay.
seeing pretty good deterioration in pound sterling and in euro. And I think with regards to the Bloomberg dollar index, which I look at, I'm a little constructive on the dollar in the short run, meaning the next probably 2 or 3 weeks. But generally the time from June has been pretty positive. We saw a very mild consolidation here. I think today's move likely is going to lead us higher in US dollar, which means that commodities might wither. You might see EM underperformance. If
Metals, correct.
they're pulling back, and so I don't know. Precious metals have been historically pretty strong in October, and I'm not willing to fade that trade yet. But I do think near term the dollar can rise. I've been thinking the dollar should start a peaking process. I don't know that we've seen enough to make that call yet. So
maybe in the spring with your S&P call?
Yeah, I wish I were smart enough to say it's exactly when the dollar peaks. I tend to take more of a tactical view only because that's what people appreciate. If I make these grandiose long-term calls and
Oh, Nostranewtons.
I think, the dollar tends to work in this longer-term 8-year cycle, similar as to euro and sterling. And I do believe that we probably peaked out in 2016. And so I do think the trend likely is going to be lower into the early 2022, to 24 area for the dollar. However, near term, it acts pretty well. When you take a look at any of the charts, DXY, Bloomberg dollar index. So most of the DeMark signals on like the euro and sterling are still a little premature to think that lows are in place. So I'm a little, between now and year end, I could take a positive stance on the dollar. That's about as far out as I want to go and say, you know what, I do think that you have a bit more strength, and the DXY gets up and probably challenges 102. That would give you monthly counter trend sells based on DeMark for the first time, based on sequential since for quite some time. So you'll have combo and sequential counter trend sells if we rally back up and really get above 102, which is a big move from 98. So, I don't know. I think that
that's a great look and excellent analysis. Kind of clears some things up for me, Mark. How about this bounce we had in yields? Is that are we going to new lows in yields, and that was just a temporary bounce? And what's your longer term outlook into what most of the money has moved into, probably the much more crowded trade than long equities, with how money has shifted the last year and a half out of equities into bonds? What's your take on them here?
Yeah, here's a long-term trend of just 10-year treasury yields going back since the 90s. And if you extend it back to the 80s, I mean, it's similar, but this is really the more realistic longer-term channel. And, I thought that potentially we were attempting to break out of that late last year, but that just proved very short-lived. We didn't make any progress. And of course, the real, the move in December sort of sealed the deal as to saying that was definitely a false breakout. And so, trends are down. We got down near former lows.
30-year took out that low, 10-year hasn't yet. Yeah.
So I would say, in general, I am, I'm thinking that we pull back and at least test these lows at 142 and probably get down to the mid 130s. However, given the recent positive correlation between equities and treasury yields, at least, it's interesting because yields have gone straight down, equities went nowhere, and all of a sudden equities are following suit. It's always tough, but trends are certainly still very negative for yields. you have started to see some evidence based on this bounce that we saw into September of some momentum was improving a little bit. So on any pullback at this point, you're likely going to see some divergences, and that could create a, at least a short-term bottom for yields. But I think you probably pull back and test, if not get below that. And the areas in 2016 were near 132. So I'm still favoring being long treasuries, TLT, and think in the short run that we have, we can probably pull back and test that. I look at a combination of cycles and DeMark and just momentum, and I just don't see enough right now to think that that it's right to be all that negative on treasuries. I think if anything, in the next 3 to 5 days, you pull back and test 146 into next week. That sounds like a severe move, but if we get DeMark type buy setups and yield right near former lows and momentum's a lot higher, I could make a case for taking a stand and trying to short, trying to sell treasuries at that point on any further strength into early next week.
Okay, Mark, I think we covered the gamut like we usually do. And anything you want to wrap it with?
I just, in general, I think it's right to pay attention to sentiment. That tends to be one of the more important things. It's even more important than news in terms of being a catalyst for longer term, intermediate term movement in the market. I think people pay such attention to the tariffs and everything else. And when you look back, a lot of this has been ongoing, and equities have been actually in pretty good shape since last December, and it really has not affected things, even though we all look at these short-term swings and, the algo type movement intraday. But bottom line is that, there's still a healthy level of pessimism, and until that changes and or we see material deterioration in stock trends, then I think it's going to be a time when you still have to, to buy dips for those that look at the market every day. And for those that are wary, we need to see a move down under monthly lows. And if that happens, that will certainly change my tune. So if I don't get the chance to speak again, if we undercut August lows, then I think, the bear market certainly has begun. I think that, and certainly under June lows, but I'm just not expecting that, right away. The one thing, it's interesting that, and I'll end with this, is that Samuel Benner ran a very famous cycle on pig iron prices way back when, and this year is a panic year according to his cycle. He tends to alternate the 16, 18, 20-year cycle, and for those that want to study those cycles, it does come up as this year, but in the past, it's just been important to monitor that. So.
Okay, a panic cycle in pig iron?
Well, he started doing pig iron, but he applied that to really everything. In terms of just looking at that numerical system for assets. And so,
all right. Wow.
That's something to, I can post some things on Twitter about that, but I don't want to say that we're going to panic, because I tend to be I'm more of a dip buyer here, and until I see things change, I don't want to spread a lot of doom and gloom. But yes, this year is,
what a great overview, Mark. You helped me. You helped me with some of the things I was considering, so I know you helped everyone that was here listening to you live and will listen to the interview. Why don't you show your website so people know how to stay in touch with your work?
Yeah, so I'm on Twitter and LinkedIn. You can certainly find me there. I do run a consultancy-based business, a web-based subscription business. I provide technical analysis to institutions and to individuals, and so you can reach me at newtonadvisor.com. I do provide a daily and weekly notes. I do a weekly conference call, and I do a video literally every day that discusses what's happening in the market. So I'll be on CNBC tentatively today at both 2:25 and also in Fast Money at 5:20 if they don't, if nothing
great
comes up. So
well, I'll turn the volume up.
Perfect.
All right, buddies. All right, and I hope you have a great fall trading season for you and your clients, Mark.
Likewise. Thanks very much, Dale. It's great joining you guys as always. Have a nice.
All right, my trading warrior brother. Adios.
Take care.
Okay, everyone, that's a wrap for us, and see you in the private members chat. Remember, don't just count your pips, count your blessings, and see everyone tomorrow. Thank you, Mark Newton.